All right, so today I wanted to have my dad talk a little about taxes. I know that we're all focused on getting higher returns in investments, but the reality is you can, at the end of the day, saving money on taxes because we pay so much has the same impact as being able to increase returns. So let's talk. You've been helping clients for 40 years,
Correct.
whether it's new couples with no money to people with $20 million of assets. So you've seen the gamut. Kind of what are your thoughts or recommendations on something that people can use today when it comes to saving money on taxes?
Well, I think one of the things that's out there that's really misunderstood, um, there's a tax law out there called 529 Education Plan, which allows families to create a education funding account for their kids. The uniqueness about a 529 plan is you can set it up as an investment account. You can put money into it. That money continues to grow inside of that account, hopefully. And at the time that your child takes the money out of that account, that money and the income of that comes out tax-free as long as we use it for college education funding. So it is a systematic way designed for people to put money in on a regular basis to grow it tax-free. However, to really make that thing work correctly, you have a limit, and so in 2015, the limit was $14,000
Okay.
that you could put into the plan, but I'll explain how you can even put more than that in. And that simply is under a different tax law called gifting, how much money you can gift to any one person any given year without having to file any other special tax forms. You can actually go up to and fund 5 years in advance if you wanted to. So you could fund 5 times that for your child. Now the question is where would you get that money? Remember that what we're trying to do is grow the money without any current taxation, take the money out to fund college education tax-free, and provide that benefit. Now the wonderful part about 529s, by the way, though, is that if for some reason you either want that money back yourself, or your child decides not to go to college, or you decide you're not going to pay their college, you can bring that money all back to yourself. So you can actually bring it back to yourself, and you could use it later in life for education for yourself, or you could actually bring it all back and use it to retire on or whatever you want. There's some tax consequences, but we can discuss that later. One of the things that I've done for years is I've showed people how to take the equity position out of your house. Equity means how much is my house worth above what I owe on it.
Okay.
So today you can go out and get a second mortgage or an equity loan on your home at a cost of probably 3.5%, somewhere in that rate in today's environment. Now, when you do that, that interest is a deductible item on your tax return if you itemize. So if you're itemizing your tax return, you can actually deduct that interest. You see those ads on TVs every day. It says, take out a second mortgage for this or that and deduct the interest. So you're able to do that. So what happens is if you were to go and borrow $50,000 against the equity in your house, that $50,000 interest on that would be a deductible item. And that cost, so if it was costing you 3.5% or 4%, whatever that rate is, then whatever your tax bracket is, that would be that difference would be how much it's really costing you to have that money. So what you do is you take that equity and you deposit it all into the 529 plan.
Yep.
Now remember, the 529 plan is you own it, but it's for the benefit of your child or grandchild or whoever you're doing this for. So now what you do is it grows tax-free in there. You pay the interest on your loan each and every year, taking that as a deduction. At the time the child goes to school, if you withdraw that money out for the payment of their education expenses, that money all comes out to them tax-free. Now, remember that we still had this loan out here that we had on our house. So during that course of years, you may have been paying that loan down each year, a certain amount or whatever. But you actually then, you yourself could bring back that principal. So if that was $50,000, you can bring the principal back to you at any time you want to, and there is no penalty for that. I'm not talking about the earnings now, I'm talking about the principal. So you could bring the principal back, pay off your mortgage on your house, and now you have found a way to leverage up the equity position of your house, put it into the 529, build the account for your child or grandchild, and have that money for them for college. If that child or grandchild does not use that money for college, you could give it, you could reassign somebody else in that same generational group, and they could have that, which we have done in the past, where they could have that funding for it, so they could take it out, or you could actually bring it all back to yourself if you wanted to, bring in the first original amount back without the tax, bring in the earnings back with the tax, and a 10% penalty by the government. So it just gives you a way to really take advantage of the equity position in your homes.
Is the 10% penalty on top of any capital gains tax you'd have to pay?
Yeah. Now remember, the tax that comes out, that if it's a taxable event, that is an ordinary income tax that
Okay.
comes out of it, and the 10% penalty is if you use the money other than college or other than education. I'm sorry, not college, any type of education. Then there's a 10% penalty assessed to that. But again, it's only assessed to the earnings, not to the original amount you put in. Okay?
Got it. And again, as long as your return in that 529 plan is greater than the interest that you're paying.
Right, it's
then
greater
that
than the
invests-
net cost of the interest, and so if you were in a 25% tax bracket and you were paying 4% interest, your interest is costing you in essence 3. So as long as you perform greater than 3%, then you are actually earning more than you're paying, and you're not having to come up with any money to do it. You're using the equity position. During the period between now and the time you start for that child's education, if for some reason you had to get the money back, you could actually bring it all back. You could bring 100% of the back, the earnings, the principal, and everything else, pay the mortgage back off in your house, but you'd have the penalty plus the tax on the excess above what your contribution is.
That's helpful. Again,
Okay.
a lot of people want to save for their kids' college education. They don't have the money to do it. So.
Yeah, and they get a little frustrated when they are only putting in a very small amount each month. It seems like they're not getting anywhere. And now they're starting to do good financial planning and understand it. So, if a person wants to be sure, you could talk to your accountant or whoever does your tax advice and verify the deduction of the homeowner's interest, because that makes sure that you're itemizing. But that'd be a great way to look at it.
Perfect. Thanks. I hope that was helpful.